Hello, everyone, and a very warm welcome to today's major markets update for Wednesday, the 15th, 2023. Looks like we have a bottom in place. Let's just go over the charts and see what we have, as there is, of course, a considerable bifurcation between markets. Some already bottomed earlier this week, whereas some bottomed today. It looks like it, and I'll show you why and what are we going to expect next. All right, so moving to the bottom line, we're tracking this WXY pattern, which went from an alternate to the preferred. It does look complete. Today's low could be a failed fifth analog to the Dow Jones, or a E/2 wave analog to the Nasdaq 100. This is the problem with the S&P 500. It's a hybrid stock between those two indexes. The Dow and the Nasdaq 100 often count and look cleaner. So from a trading perspective, those can actually be a little bit more advantageous, though many focus on the S&P 500. But please keep it in mind, what you're focusing on might be a diluted drink. So we're going to look at the hourly charts. I am tracking a mini impulse higher from today's low on the S&P 500 5-minute chart. Looks pretty good, especially with the last 5 minutes today. Looks good, looks good. So the downside looks complete, especially for the Dow Jones and the IWM, with clearly Fibonacci-based 5 waves impulse patterns lower. The Dow Jones has just been absolutely picture perfect. For all of you clowns out there that don't believe in the Elliott Wave, you can stop watching because there is no hope for you. This is as beautiful can get. That said, as long as today lows holds, we should look for higher prices. So we now have a well-defined, clear stop loss level in place. Remember, trading is about minimizing risk. There is never no risk. As soon as you wake up, there's a risk of you dying because you can fall out of bed, crack your skull. Wouldn't be the first one for that to happen. And the rest is then history. The ideal upside target is, yes, 4,500 on the S&P 500. But we must be cognizant of the fact that we have had 5 waves lower on some indexes, so we must expect at least 3 waves back up. See the Dow Jones daily chart, alternative count. So it's still early days because some indexes bottomed today, whereas others bottomed on Monday. So we have limited price data available, but it looks like the Nasdaq could be already in a leading diagonal first wave of this larger C wave. So it will be kind of a stop and go initial overlapping advance. Wouldn't surprise me if that's the case, as overlap has been the name of the game ever since we talked in 2022. Yuck. It is what it is. I don't make the market, I just track it. And also remember, if this larger C wave's underway, C waves can become diagonals as well, which will be an even bigger puke. But it is what it is. I don't make the markets. Last and not least, seasonality. This is in italic because this was already on Friday's slide, and I've shared with you this before. Seasonality for pre-election years in the United States have a high March 5th, and I think we got March 6th because on March 5th was a Sunday. So yeah, we're not going to trade then. And a low around March 12 to 14. So the turn date is March 14, 15 plus or minus 2 days, and today might be the day. So far, so good. So this is our kind of general roadmap. And of course, when the market starts to deviate from it, we know we don't have to follow it anymore. But it has been following this roadmap reasonably well. Remember, this is relative. We're not looking at absolutes. We're just simply looking at the market direction. That we dropped to pretty much new lows for some indexes, even the Dow Jones. Well below, for example, the February lows and are testing like December lows. That doesn't matter. It's about the direction. Down, up, down, up, down. That's what matters. We're looking at direction. So don't get hung up on absolute numbers. That's why I even cut off the levels for the y-axis, because some people just get too hung up with it. Remember, importance of stop losses. Can't say it often enough. Don't ever double down. At the most, I would say average down once, and then it's hands off and let it run up or down and get stopped out or take your profits. Bigger picture-wise, we should be in this C wave of B wave, and B waves are very complex. I'll show you also Netflix and why that one could be a nice canary in the coal mine for the C wave of the B wave. So here we have the hourly chart of the S&P 500. And last week we bottomed 3 points shy of the ideal upper end of the third wave target zone. We then rallied within 2 hours to the upper end of the ideal fourth wave target zone, and then dropped to 39.08, well inside the ideal fifth wave target zone. So I should then, of course, place a wave 5 label here, but I prefer to not always do it because I have simply a limited number of characters that I can use on a chart available. And when I go over that limit, stock charts won't save crap anymore. That's kind of what it is. So then we have 5 of C of B. Missing some of the data, unfortunately, 4 or 5 hours of data is gone. It's sad, but it is what it is. And then yesterday's high was A1, A, B, C, lower for B/2, which bottomed here in the ideal B wave target zone, which is in this case 67.4% retrace of wave A. And of course, we break above the first warning of the bears, 39.35, I believe it was. In this case, 39.37. That's the high we had yesterday. Then we are going to be in wave C/3, a 4 and a 5. And that, my friends, should only complete then wave 1 of C. Okay, this is not all of C. 1, 2, 3, 4, 5. And then, of course, we get wave 2 of C, lower, etc. Right? We're going to go through the machinations, but C waves are 9 out of 10 times 5 waves. So that could be the nice setup. Alternatively, very nicely, we could have had an irregular flat wave 4. It counts well as only 3 waves lower to the 39.08 low. And then we completed 5 waves lower, counts reasonably well for a failed 5th. Well, actually not, just this was a irregular flat 4th wave, and we just discount this one. And we got today to as low as 38.38, which is only 8 points below the ideal 5th of the C wave target zone. So either way, I think we have a low in place. Looks good. Above yesterday's high, and I'll be looking here for the low 4000s, etc. Okay, this wave count here, the ABC, is based on that from the Nasdaq. Okay, the Nasdaq is already further along than the Dow Jones. All right, the Dow Jones made a new low, whereas the Nasdaq did not. So that's then the two things we count. Both look for a completion of these corrective price action that we've had since February 2nd. In smallest of smallest details, this is the 5-minute chart. So we have then our potential A1 and B2 here. This is the high made on March 14th, the low made yesterday, A, B, and the C. All right, look, this is unbelievable price action. You rally nicely into the close, and you wake up in the morning. Booyah, that is something. I mean, most of these market moves are made after hours, which is a little sad, I must admit, but it is what it is. And here you can again see the gaping data gap. Nothing I can do about it. It will probably never get filled. So we move on and look at what we do know. It looks like we now have a nice impulse higher from around 1 o'clock Eastern Standard Time. Look at this, 1, 2, 1, 2, 3, 4, 3, 4, 5 should now be on the way. Nice massive hourly candle here. I know it doesn't mean anything because this is what we saw yesterday as well. But I'd like to see us rally to around 39.10, 39.02 for this wave 5. That would be gray A1/2, decline, and then rally again. So then we get, of course, if we fill that in, of course, 1, 2, etc. Okay, so then we are 1, 2, etc. Then we are somewhere here. Let me add that for you. Then we get something like this. This would then be gray 1 here. Okay, then we get probably a quick drop here for wave 2, and then of course it is off to the races. Whatever the news will be, we'll have an explanation for it, but I don't need an explanation. I just need the other waves, because how else could we exactly forecast where things will top and bottom? All right, especially on the Dow Jones. So that's the S&P 500. This is very short term, 5 minutes. So this is what I prefer to see. Doesn't have to, can always extend, of course, for this wave 5. I really like to see it. If not, and we drop again, then all we got is 3 waves higher. And this all goes out the window. I can redo it again, as I've been redoing 9,462 charts in 1 hour every day since the last 50 days. So here is then the NASDAQ 100. Looks pretty clean. I'm looking here for a potential 1-2-1-2 setup or an A-B-C setup. Don't know yet. Too little price information available. But we already yesterday got the first warning for the bears and the second warning for the bears, because now we had overlap with this wave 1. So a fourth wave cannot overlap with a first wave unless it is in a diagonal. That's the only option. This doesn't look like a diagonal. Well, the price action here is extremely horrible. So this also looks corrective to the downside, A, B, C. And now we should be impulsing higher. Here are the price targets based on a diagonal. So we'll have to take this with a little bit of salt, because I don't know exactly what the price pattern is. Is it a 1-2-1-2 or is it an ABC for a diagonal? I prefer to count diagonals as ABCs because they're relatively overlapping. And as you can see, it doesn't take much for the futures market to gap over this downtrend line. If we gap over this downtrend line, the gray solid downtrend line, I already mentioned that yesterday, and then we should look for higher prices, because then this downtrend is over. Very simple. This is held price in check ever since February 2nd. Here, 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 essentially here, and we're getting very close. We've already broken above this red downtrend line. We've already broken above the warning levels, subsequent 1 and 2. So the bearish case is certainly in trouble. We've done technically enough waves to the downside. Boom, wave 3 hit the target zone. Boom, wave 4 hit the target zone. Boom, wave 5 hit the target zone. I got to add the sound effects because we keep nailing these target zones, because Elliott Wave works. And for those that are listening and are not members, if you don't think Elliott Wave doesn't work, yeah, don't know what to tell you. This is the NASDAQ 100 daily chart. We've bottomed so far in the ideal C of B target zone, and we're rallying higher. We're back above the 20-day. We've held essentially the moving averages except for one day, the important ones, the 250-day. And if we can now break higher, especially, of course, above the February 2nd high with the first cutoff here, the March high, then we're looking very nicely here for this CSA rally to about almost 14,000. This blue box is the retrace of the entire decline since the 2021 high. Yes, the NASDAQ 100 topped already in November 2021. The market doesn't hurry up. It's still going to be 2 years ago. That's a hallmark of a bear market. So if you hold on for stuff too long, you will not make any money, because it's a waste of time and resources. It's better to cut your losses and move on. And never cut them after 80% loss, because after 80% loss, it takes 200% to get back to break even. You know, keep losses always within 5% of the actual trade, and not more than 1% of your entire portfolio. That requires 100 losing trades in a row to go pretty much break even, right? So always make sure you keep your losses tiny. This is Netflix. I had a nice chart, but I guess, again, stock charts decided to not save anything. I should probably sue these people for loss of work. So here is the ideal wave B target zone. Normally it's 50 to 62%. Doesn't have to, can be 38.2%. Okay. So we had wave 1A up here, complete as a 5-wave impulse with a ending diagonal 5th wave, quite overlapping, but you can see how nasty diagonals are. 4, 5, wave A, and then this could be wave B. Now we're going to add in the bigger retrace for the larger wave B that I am tracking. So my humble opinion, Netflix completed primary A here, similar to the market as well. So Netflix already bottomed in the summer last year. Yes, in the summer. So then we have our B wave, and normally the A wave of a larger B wave reaches the 38.2% retrace of the initial A decline. Then the B of the B wave reaches the 23.6%. I mean, bingo, my name is Bingo. This is fantastic. This is absolutely fantastic. So you can see how the smaller waves line up with the retraces of the bigger waves. This is classic. So classic, I would, if I would know not any better, I would say this would then be wave A. Very crude. I would paint it in a monthly chart. This is wave B. And then this would be wave C for a nice zigzag CSA relationship. 5, 3, 5. Okay. So far, so good. We went a little bit above it, 380 instead of 368. Crimea River, give the market a break. And then we should now see, we went a little bit below it, of course, as well, where we broke above, we went below. And then we get, of course, wave C. Okay, we should see a nice impulse. So that looks pretty good. And then we have a 61% retrace of the entire decline. Classic for wave B. We had 5 waves lower here in black, 1, 2, 3, 4, 5 subdividing wave 5, subdividing wave 1, subdividing wave 3. Beautiful. So then we get the bounce here for wave B, or C of B, right? C is A, 61.8% retrace. Classic, absolute classic. Doesn't take a rocket scientist to figure it out. It's all on the internet. And safety, nothing. That's fine. You got it. And then we get, of course, the C wave lower. Matches very nicely what we're following, of course, for the markets B, right? B and then C. All right. This is going to be, hold on to your hat. I don't know what's going to crack. Fed's probably going to do something stupid. Well, they always do something stupid, it seems. So let's say the snow is white. That's what's going to happen. Something's going to happen. Do you know why? What? Don't care. Doesn't need to. This is then the Dow Jones. Look at this. 1, 2, 3, 4, 5. Wave 3, exactly 161.8. Wave 4. Picture perfectly would stall here at the 100%, the lower end, 32,150. We got a little bit higher. And as you can see, it already stalled right here at the first warning sign. And now 5, look at this, 1, 2, 3, 4, 5. Picture perfect to the 176.4% extension. Massive positive divergence, especially on money flow. Money flow is critical. It drives markets. You can see we went lower in price, but money is pouring in. I've been buying and buying. Now, I've been trading, but my positions are way too small to make any difference. I like it. We've technically done enough. So first warning level has already been reached. Second warning level is, of course, above yesterday's high, 32,300. And then we break above 33,000, and then, of course, 33,600. With the ultimate is above the 34,400 level. Right? We need to break, of course, above the high we made in December. Yeah, we don't need to go back that far for the Dow Jones to tell us that indeed wave C/3 is underway. But that's waiting a long time, but that's from a pure technical Elliott Wave perspective to get that confirmation. We have, of course, much lower levels to tell us that if one is short, for example, to get out because chances that you will make more money on it are getting lower and lower, the higher things go. If one is short from lower levels. That's why I put these warning levels on there. The same for the bulls, of course. So simply put, as long as today's low holds, I think we have a nice low in place. Looks good also on the daily chart. 1, 2, 3, 4, 5. Look at that, picture perfect. And then we're going to watch now for this C is 3. Remember, alternatively, we're only going to get a bounce for this wave 2. We did 5 waves lower. 1, 2, 1, 2, etc., etc., etc. So it is possible that all we're going to get on the Dow Jones is a second wave bounce, whereas the S&P 500 and maybe the NASDAQ 100 continue to rally. That's something else. And then we get a third wave lower. So please keep in mind, this is not a bull market by any means yet. But we did everything picture perfectly, 3, 4, and 5. I like it. And then wave 2 here, in this case, should go to about 33,200. In this case, we're going to look here to about 35,000. Slight difference. But please remember that Dow Jones is in an entirely different wave count, actually, than some of the other indexes based on where it topped and bottomed already. The market knows where it has been, the market knows where it is, and the market knows where it wants to go. It is for us to figure out the last part based on the first 2 parts. But the market knows it, but we need to figure it out. Semiconductors, horrible mess here for almost a month now. I haven't touched this one in a while, but it starts to look good. If we break out now, this would finally give a good signal. It's failed to break out 3 times in a row now. But again, that's what can happen, meaning break out above the 20 and the 20 and the 20 days moving average 3 days in a row, so to say, or 3 times, and every single time we got punished. This looks highly corrective price action. Does look complete. We have nice positive divergence going on. And also here, as long as this week's low holds, we should be able to move high. It's going to be critical. It is setting up for a big move. How do we know it? Because the Bollinger Bands are contracting, getting very tight. We're holding the 50-day and we're above the 200-day. So the benefit of the doubt goes to the bulls. They lose these moving averages, and we'll see something akin to what we saw here for the small cap. Small cap, this is an unadjusted chart since Friday. We were looking for a bounce on Friday and then another decline. Well, what did we get? Can't get it exactly correct. Here, this is then wave 3. Here is then wave 4. And here is today's then wave 5. I have no confirmation yet that wave 5 is complete, but it looks good and we might have potential positive divergence. It requires a close higher tomorrow to confirm this positive divergence. That'd be really something. But this is followed quite nicely. The 3 would have looked better here. We could have done an ABC, by the way, similar to the S&P 500 ABC. That is fine, but this looks pretty nasty with these gaps. But today's gap again got bought up. That's quite interesting. So we might see a massive gap up tomorrow. That remains to be seen. I can't predict the future. I can only forecast the waves. So the IWM looks complete. And again, this shows you what happens if the dam breaks, then we start to really impulse rapidly lower. But we have now completed technically enough waves to the downside to consider this initial decline complete. So I'm looking here for a bounce back to at least the 200-day moving average. This also is an index that I don't like. It looks weak. It's below the 200-day, etc. So this is also one that I am not going to touch. All right, so that's all I have for today. Quite simple. Looks all complete. If seasonality now wants to kick in, we should start rallying. Okay. If not, then we can ditch this chart as well. And the market is doing something entirely different. But I think we had some good Netflix example on why we should rally, especially for tech. I know it's only one out of thousands of charts, of course, but just wanted to show you how that can help us understand what the larger indexes will do. It really looks like Netflix needs another leg higher to follow an ideal Fibonacci-based B wave to the 62% retrace after having topped at the 38.2% retrace, bottomed at the 23% retrace, and then the CSA will get us to the 62% retrace, which would match nicely with the NASDAQ 100, S&P 500, and the Dow Jones could just do a bounce, wave 2 to be determined. But I think from now on, downside risk versus upside reward is skewed more and more towards upside reward. Take care, trade safe. See you all on Friday. Bye.